welcome to The Trade. Let's get you caught up on what traders are watching, with Tesla shares closing up nearly 22%, their biggest single day gain in over a decade. CEO Elon Musk's bold forecast of surging sales reassuring investors he's still looking to grow its core business of selling EVs. The Bank of Japan Governor Ueda has said that the optimism over the US economic outlook is broadening, but markets remain unstable, offering a mixed view on whether risks to his country's economy are subsiding. The White House has said it's encouraging Boeing and the union representing around 33,000 striking machinists to continue working to reach a deal a day after workers rejected the plane maker's latest contract offer. UPS reported better than expected quarterly profit and revenue ahead of the crucial peak holiday season, boosted by rebounding volume and effective cost controls, as shares soared as much as 10%. And the US Interior Department has given final approval to Aussie miner Ioneer's lithium mine in Nevada, the first domestic source of the battery metal to be permitted by President Biden's administration, and one that will become a key supplier to Ford and other EV manufacturers. Let's get straight into the charts now that matter. Ilya Spivak from Tastylive joining me. Always good to see you, Ilya. Wow, what big moves we've seen in the bond market this week.
Very good to be here, Juliet. And yes, indeed, the bond market has really been the focal point for me as we watch what's going on here, because the U.S. reflation trade is very much on. We're, of course, seeing a sharp steepening of the U.S. yield curve since that Fed meeting last month. And that top there at just above the 127 level, that's the eve before that Fed day. And what we can see is the market saw a 50 basis point rate cut and said, right, you are pouring stimulus on top of an economy that's doing well. In fact, we just saw the PMI numbers earlier today for me here in the US, overnight for you there in Australia, showing the US economy continues to grow at a pace that's lining up with the 12-month high it reached back in May. So for 5-6 months now, we've just been hovering at this elevated rate. More stimulus, as the Fed has offered here, is likely to be inflationary. And so we've seen the scope for future rate cuts get diminished, hence the 30-year here sinking, and not only pushing lower, but actually taking out the bounds of the trend, going all the way back to late April, early May of the year, when, of course, the bulk of the rate cuts really started to get baked in. So we see here a significant reversal. Maybe we'll get a little bit of a bounce off this interim support here. The bonds perked up a little bit over the course of today, but the path of least resistance seems to be very much toward higher interest rates and lower bonds here. We seem to have crossed an important threshold in the past several days.
Indeed, and an important threshold too as we continue to monitor, I should say, currency movements ahead of that very big election coming up in your home country. How's the Aussie tracking against the greenback?
Well, that's exactly right. So higher U.S. yields at a time when the rest of the world is very much not going the way of the Fed. In fact, those same PMI numbers we just saw overnight gave us some sobering readings for much of the rest of the world. The U.S. increasingly diverging, and that, of course, is creating yield differentials that benefit the dollar. I picked the Aussie here to look at as a reflection because, of course, here is a central bank that is resisting rate cut. The RBA has been stubbornly hawkish relative to other central banks, and yet there's the Aussie going down. And what this really reflects is just how dominant the U.S. dollar is in global payments and global commerce, whatever might have been said at this week's BRICS summit notwithstanding. So we're looking at a situation where when the U.S. gets hot and expectations for Fed rate cuts get diluted for next year and U.S. yields go up everywhere. And that's having a knock-on effect at a time when the global economy is actually slowing because the U.S. has not exported this robust demand overseas. Most of that demand is going to domestic services. It's not going to the buying of imported goods. So we have a situation here where the world is slowing, but the U.S. is risking the foisting of a tighter credit regime on top of that slowdown. And so what we end up with is of course, some outsized pain for something that is so linked to the global business cycle, like the Aussie, RBA hawkishness or no. So we're seeing it sink here to some very important levels and threatening to break even lower.
Okay, then let's have a look at the broader market, because the S&P 500 did have its first win of the week overnight our time, of course, the day for you. But when you look broadly, a lot of the sectors were in the red. So what is the sentiment or the technical showing us at the moment?
Well, this is exactly it. So one of the few pockets of resilience where you haven't seen the kind of dramatic repricing is stocks. They've been holding on for dear life here, but what you do see is, of course, they've started to pull back, and they're essentially sitting on the dividing line that would turn this pullback into a full-on reversal at about 58.30 on the S&P. And you make the point, I think, very astutely. It was a less than great day when you look at the sector breakdown. Most of the strength seemingly linked to tech and those explosive Tesla earnings. When you look at the broader market, there's quite a bit of weakness here. And the concern is, of course, if we do keep getting hot U.S. economic data and yields keep going higher at a time when most of the world can ill afford it, you're running the risk of a global recession, U.S. resilience or not. And that, of course, doesn't bode well for multinational corporations' earnings, and that's who we're looking at in the S&P 500.
All right, Ilya, always a pleasure. Have a great weekend when you get there. I know you're a day behind us, but have a good one anyway. And that is, of course, Ilya Spivak from Tastylive. That does it for today's edition of The Trade. We'll be back next week.